Welcome back. This morning, the Labor Department reported that non-farm payrolls grew by 236,000, less than revised 326 for the prior month. The unemployment rate fell to 3.5%. We can see the black dotted line represents the overall non-farm payroll number. The red are private sector non-farm payrolls, and the yellow are non-farm payroll services, all trending really kind of lower. What's holding steady at the bottom are the red lines and the green line, the red and green line, which is non-farm payroll government and goods. But we can see overall, with a few blips along the way, it seems to show us a trend to the downside. The following over here is a year-by-year addition of non-farm payroll in terms of the different segments. So, for example, the orange histogram bar in 2022 shows us a 3.3% increase in non-farm payroll. We don't have really a lot of data to work with so far for 2023, but we can see that 2022 was really represents a downturn or a disappointment from the prior 2021 year. Now, of course, 2021 was a huge recovery after the 2020 stock market sell-off, crash. But it seems, and we're going to see in some charts, in the next few seconds here, that there seems to be a case where the market seems to be running out of steam, and a lot of these economic numbers are maybe following suit. This shows us the 9-year correlation between the S&P 500 and the different non-farm payroll categories. So you may wonder, okay, the jobs number is a little bit weak today. What does that mean for the stock market? What's the connection? Well, on the left-hand side, the blue histogram bar shows us the overall non-farm payroll number. That has a 62% correlation to the S&P 500. So a 100% correlation is a one-for-one relationship. One stock goes up by 1 point, the other goes up equally. 62% is a pretty strong correlation. Non-farm payroll, private sector, 65. Goods at 68. Services at 61. So all these categories seem to have a pretty strong correlation over the long term, except for non-farm payroll government, which seems to have only a 10% correlation, virtually no connection between the amount of jobs created in government agencies and the S&P 500. The red line represents here the S&P 500. The yellow lines represent the labor force participation rate, very simply the amount of people participating in the labor force. And that's registered another high. It seems to be growing over time. Now take a look at 2021. The red line, S&P 500, goes up. So do the histogram bars, the labor force participation rate. But there's a break in this relationship. Around January 2022, the stock market started to head south, while the labor force participation rate continues over time to climb. What changed? Perhaps my best guess, this is really the onset of the inflation that really is weighing heavily on corporate earnings. Same situation, average hourly earnings are in yellow, and the red line is the S&P 500. And this grows over time, but the stock market really took a break from its upward trend January 2022, while the average hourly earnings continues to rise. S&P 500's in yellow, the unemployment rate's in red. It's the same correlation. As the unemployment rate ticked down, the S&P 500 ticked higher, which is a good thing. However, unemployment rate continues to hit almost near record lows. Why is the stock market not hitting record highs? We see here the gray histogram bars show us the average return by year for the S&P 500. The red, purple, yellow, blue, and green histogram bars show us the individual non-farm payroll components. Notice this in particular. So in 2020, that was the obvious COVID crash. The overall non-farm payroll, which is red, was down 774,000. That's on average how many jobs we lost for the year 2020. The purple line is non-farm payroll private, 686 to the downside, etc. 2021, we had a huge recovery. But 2021, we added 605,000 jobs. 2022, we added 399. 2023 so far, 344. We're seeing lower highs across the board. The overall non-farm payroll number is declining. The blue line, which represents services, is declining. The purple line, which represents private sector, is declining. The yellow, which is goods, is very, very small, but hanging near the lows. The only histogram bar that's actually risen over time and represents actually probably the highest high we've seen in at least 8 years are non-farm payroll government. However, unfortunately, the prior slide we saw, there's virtually no connection between government non-farm payroll numbers and the S&P 500. The gray histogram bar shows the S&P 500 by year, and then the red unemployment rate. Take a look at 2019. That's the kind of year we would expect to see, given the data. The S&P 500 was up very strong that year, and the unemployment rate was very low. 2019, the opposite obviously took place, but so far the unemployment rate continues to tick lower. Why is the S&P 500 so lackluster? Labor force participation rate continues to climb over time. That's in red. The yellow is the S&P 500. So we're seeing here a real disconnect, and we mentioned this in prior recordings. The GDP, construction spending all showed, to one extent or another, some significant improvement. Also, we see here today average labor force participation rates increasing. The average hourly earnings is increasing. The unemployment rate is falling. Why has the stock market disconnected from this? And I think that one of the obvious answers is inflation, and also the very high interest rates brought on by Federal Reserve activity. So the question really is, moving forward, we need to watch inflation and we need to watch the Federal Reserve. And in order to really, I think, best guess what the Federal Reserve is going to do next, I think the bond market will tell us that. We've discussed in recent videos, just in the past couple of days or so, the inverted bond market and basically the history of it and how it's behaving now. And moving forward, I think it's going to be very, very interesting to see how the bond market behaves. And we're going to really dive into that with a much greater amount of detail moving forward. We hope this has been helpful. We look forward to seeing you back soon.